It's 2021. Bitcoin is worth in excess of $50,000. It's too late to buy in. You've probably heard this narrative 1,000 times. You probably heard it back in 2017 and in 2015. But what experienced crypto investors know is that Bitcoin has the potential to grow in value up to 7 times from where it stands today. But there are other very exciting things happening in the world financial markets that you should be aware of. For example, you can buy payload on the moon rocket, pay for it with Dogecoin, which began life as a joke and has no real value. These things will have a massive effect on our day-to-day lives. I think that these arrivals in the world financial markets are fascinating. This is decentralized finance based on cryptocurrencies. And I believe that this is something that everyone needs to have a good, solid knowledge about because it will become essential. My name is James Williams. I'm an investor, financial advisor, and public educator. And in this masterclass, I want to give you the vital knowledge to take off in the world of cryptocurrency investing. Even if you have little or no knowledge of what cryptocurrencies actually are, just spare a couple of minutes. Join me and we'll be ready to fly. Let's go. So in this masterclass, there will be no complicated what is cryptocurrency or what is blockchain focus. Instead, what I'd like to do is provide you with the basic tools to kick off in the world of cryptocurrency investing. After all, what we want to do is make money, not just participate. So to do this, we'll begin by focusing on the foundations of cryptocurrency, and we'll take a look at the macroeconomic impact of it on the world financial markets. So how does cryptocurrency have value? Well, let's look at Bitcoin as an example. Now, we can use basic economic principles here to determine if it has value or not. It must check 2 boxes: scarcity and utility. Well, let's focus on scarcity first of all. Scarcity talks about there being a finite amount of something. Therefore, there is not an infinite supply. And this absolutely applies to Bitcoin. Bitcoin itself has a cap of 21 million Bitcoins. And this scarcity means that it's actually seen to be more valuable than gold. How is that so? Well, with gold, if we look back in history, think of the California gold rush. By accident, a bunch of people found a lot more gold. Everybody rushed there, and the world's supply of gold increased. Not only because of the gold rush, but because of technology improving. So now, today, we can produce 4 times more gold than there was 100 years ago. And what about its utility? Well, Bitcoin's utility lies in the fact that it has the potential to be a more efficient commodity or currency than what we currently have. And what proponents of Bitcoin will cite here is that it is decentralized, meaning that it is not controlled by any single financial body, government, or individual. One of the benefits of this is that it is hard to be brought down from the top, say by corruption. The other thing that we can talk about with Bitcoin is that it is trivially divisible. This essentially means that it can be used to pay for things, ranging from a donut to a car or a house or even a mansion. Now compare that to gold, which is very difficult to use transactionally. Imagine walking into your local coffee shop and paying for your coffee by shaving off some pieces of gold. You might get some funny looks. Now, what you may have noticed is that everything that I have mentioned so far does not cover intrinsic value. So what is intrinsic value, you might ask? Well, it's essentially a measure of what an asset is worth. And there is no universally standardized way to think about this. But what many analysts do is they take into consideration 3 factors: qualitative, quantitative, and perceptual. Qualitative factors, such as business model, governance, and target markets, are those which relate specifically to what the business does. quantitative factors found in fundamental analysis essentially refer to financial statements and financial ratio analysis. And finally, perceptual analysis tries to figure out what investors believe that the commodity is actually worth. Now, looking at those three, you might see that Bitcoin doesn't really have any intrinsic value. And this is what skeptics love to mention. But if we take a look at, for example, gold and paper money, well, they also don't have that much intrinsic value. Now, according to the Federal Reserve, it costs 12 cents to create a $20 bill. And that essentially means that the remaining $19.88 of value is based on the trust that you and I put into that system. And in that sense, this is no different from Bitcoin. The value is derived from the trust that people place in it. So if we can agree that Bitcoin has some value to some people, how do we determine what that value actually is? Now, you will see people making estimates about this all the time and wonder perhaps, how are they coming up with those figures? Well, one of the most popular ways to do this is by comparing Bitcoin to gold, because most people see these two commodities as incredibly similar to one another. The total value of gold mined worldwide up till now is $7.5 trillion. So if we imagine that Bitcoin was to replace all of this gold, then each Bitcoin would be worth $357,000. How do we arrive at this figure? Well, we simply take the total value of all the gold in the world and divide it by the amount of Bitcoins that exist. Now, this figure may seem completely ludicrous to some of you, but it's not that far-fetched, considering that this year Bitcoin has been worth up to $60,000. And there is another theory of analysis that we can use. This is called Metcalfe's law. Metcalfe was an engineer who essentially has proven that the value of a social media network or a telecoms company is equal to its amount of users squared. One telephone on its own is pretty much worthless. You can't call anybody. But the value grows exponentially linked to how many telephones are sold. So, since 2013, 94% of Bitcoin's value can be explained using this formula: number of users squared. More than a third of the world's population do not have access to basic banking facilities, such as loans or a checking account, that they can depend upon in times of financial crisis. So what do they do in this moment if they're faced with such a crisis? They generally have to resort to speculative and dodgy lending practices, where the interest rates offered to them are anything but fair. These astronomical interest rates further destabilize their financial situation. This is where cryptocurrencies come in to help. Their volatility and decentralized nature allows them to be more accessible to people around the world. There are a continually increasing amount of apps and platforms that people can use to access cryptocurrencies. Their decentralized nature as well makes it easier for people to trade across borders, thus giving these financially disadvantaged people more financial independence and empowerment. Now, blockchain processing and recording systems can actually be more secure than traditional payment methods, and this, of course, contributes to Bitcoin's increasing value. But if Bitcoin is going to be accepted as a currency of the future, then it needs to be universally accepted, meaning that people are happy to use it as a currency. To do this, a currency needs stability. And that means that we can talk about consumers and merchants being able to agree upon a set and fair value for their goods. When the price of the money itself is constantly fluctuating, this is quite hard to do. As for a crypto revolution in the economy, well, I believe we're not quite there yet. You cannot walk into a shop with your crypto wallet to buy your wine and cheese. But there are more and more platforms becoming available, giving you access to the currency and exchange methods. There is still a long way to go, but I think we're on the right path. Another important feature of cryptocurrency is its ability to store value. Like I said before, Bitcoin is like a form of gold. It has a limited supply, it's stored in a decentralized way, and it's highly speculative on trading. Compare that to shares, bonds, and real estate, who have their profits directly tied to what is going on with the market and the companies that they're connected to. Gold and Bitcoin, on the other hand, have their value agreed upon by investors who ultimately decide what they are both worth. Now, both gold and Bitcoin have limitations that resulted in them no longer being used as currencies, and they sort of evolved into a means of storing value. The big difference between the two, of course, is that gold is a widely accepted store of value because it's been around for thousands of years, whereas Bitcoin is definitely the new kid on the block. I assume that you already know something about support and resistance, so I won't talk about that here. What I'm going to do instead is take a quick look at some basic trading indicators that will help you to improve your trades. Let's take a look at some coins. Let's go straight to ADA. So what can we see here? Crypto charts can be displayed with various time frames, depending on your intention. You can choose to sort out a graph for 1 hour, 24 hours, the whole week, or all those pieces of a project. It also reflects your trading style. Day traders often concentrate on short periods so they can extract the best shots within the same day. Swing traders may want to look at a longer duration, for example, a couple of days or a week to check price moves, while long-term investors may look at periods of months or years. There are different ways to visualize charts, so you should get familiar with that. Price can be displayed in a simple line that merely describes price changes during the selected timeline. Charts are divided into two types: logarithmic scale and linear, or aka arithmetic scale. The linear scale represents price changes in absolute values, while the log scale draws the reversal in percentages. Sometimes these two lines look a lot alike. The only difference is in the vertical scale. Price in linear charts is chopped off equally. When in log charts, the price scale is divided by percentage changes. You should be able to tell which one you're looking at. Log charts, often set in the default view, reflect the trend in the amplitude of the total price. You can also look at below these charts for the volume indicator, which presents how much crypto has been traded in that period. Combined with the price chart, volume indicators can help build the most vivid picture of the market. Also, I like to operate with RSI, a relative strength index, which basically provides technical traders signals about bullish and bearish price momentum. Just for beginning, you should keep in mind that asset is usually considered overbought when the RSI is above 70% and oversold when it is below 30%. Another good indicator is ATR, average true range. This one is a measure of asset volatility. So basically, I use it to have a possible deviation in real coin price compared to projected. In this case, ADA has ATR 0.02, which means that if I forecast the price of the coin at the level of $2, the real price would be $1.98, as well as $2.02. So I have a better clue about what's going on with my models. The bull market has two typical candlesticks, which are the hammer and the reverse hammer. They are specified by a green color, whereas the hammer, the thick column, lies on the top, the tail below resembling an uptrend following a downtrend. The reverse hammer has the fifth column hung at the bottom, indicating a more stable uptrend throughout the session. Conversely, there are hanging men and shooting star candlestick patterns. These symbolize the bearish market. Hanging man with a red, thick column on the top of the line giving a signal about a recession after a bull, while the shooting star has the red at the bottom, warning about a mainstream downtrend movement. You can look at a market depth chart to get a picture of the supply and demand of the current market. In this chart, the green area indicates the number of coins in buy orders at that moment, while the red area shows the sell amount at that current price. The vanishing point between the two sides is the current market price. You can move your mouse anywhere to take a closer look at the specified price and sold or bought amount. There are also 3 lines on the candlestick chart that are MA, moving averages. It is calculated by taking the arithmetic mean of a given set of prices over the specific number of days in the past. In our case, 7, 25, and 50. The reason for calculating the moving average of a stock is to help smooth out the price data over a specified period of time by creating a constantly updated average price. And our next indicator also uses the simple moving average, and it's called Bollinger Band. Just as the name suggests, the Bollinger Bands add an upper and lower band, factoring by the standard deviations around the moving average. The moving average line moves closer to the upper band. It typifies an overbought market state. The other situation indicates an oversold state. So I hope you got something useful from this brief explanation. And what I'd also like to share with you are some general trading rules. Invest periodically. You should avoid investing all of your savings at one time. If you invest the same amount regularly, then essentially you buy more of the investment at a lower price than you do of it at a higher price. This is also an excellent way of diversifying your interests. Create and maintain an emergency fund. Most smart investors have enough money set aside to deal with financial emergencies, such as sudden unemployment. This should equate to roughly 6 months' worth of wages. You can easily automate a small amount of money to be put aside each month to contribute to these savings. Stay away from tips and rumors. Friends and colleagues will always be presenting opportunities for the next big thing in crypto, but most of the time, these things turn out to be untrue. If you focus on your fundamentals, then you are in a much better position to make money out of your investments. And please, never follow chat room alerts. The cryptocurrency market is a zero-sum game, meaning that for one guy to make $1 million, 1,000 people have to lose $1,000. Now, how do you differentiate between the winners and losers? Well, some people talk about luck or experience. I say that you will have no luck if you are inexperienced and illiterate in this field. That's why our team of educational and financial experts have put together a well-structured and comprehensive guide to help you start making money on cryptocurrencies right now, as well as providing you with a set of vital tools to be able to get going. All you need to do is watch my videos and follow the action plan. You'll learn all the ins and outs about decentralized finance and blockchain technology. To do that, click on the button below to get started. Thank you and good luck.